Okay? And we have two possibilities. Okay? So, buying and selling, buying government bonds, selling government bonds. Okay? So if we want to expand money supply, so what should we do? So increases in money supply are related to if the central bank sells government bonds to the private sector, what happens? They are taking out money from the public. So if we want to increase money supply, buying government bonds. Okay? If we want to decrease money supply, we should do the opposite operation. Decrease money supply, so we should sign government bonds. Okay? So this is the situation. So what happens to one of the most important macro variables, the interest rate? What happens if, for instance, we decide to change money supply? Okay? If we decide to change money supply, we might represent the change in money supply in the money market. Money market. Okay? So we have this situation, okay, where we have money supply is basically fixed, okay? The stock of money circulating in the economy is fixed, is determined by the central bank, and we have the other side, the demand. So the intersection between money supply and money demand determines the equilibrium. Okay? So the equilibrium is when money supply is equal to money demand. So it means it's going to be that the interest rate, okay, is going to be the equilibrium. Okay? So here we have this excess quantity of money. Okay? Good. So if we are here, what happens if with the interest rate, what happens to the interest rate? If we decide to increase basically the central bank buys government bonds from the public, what happens to the money supply? Money supply will increase. So what happens to the money supply? The money supply will shift to the left or to the right. So money supply will shift to the right. Okay? So increases in money supply will lead to decreases in the interest rate. Money supply, increases in money supply, the money supply will shift to the right. Good. What happens if we decrease the amount of money circulating in the economy? If there is a reduction in money supply, so the interest rate will increase. So we will reach another equilibrium, of course. This is related to E1, okay, equilibrium E1, and E2 is the new equilibrium. When the money supply shifts to the left, and we will reach another equilibrium, and here the same. This is the demand for real balance. Because, remember, also the way we basically explain this negative relationship between the interest rate and money demand. Demand for real balance. Money supply divided by the price level. That's the demand. So remember, first of all, if we increase money supply, so what basically there is an increase in the interest rate, and this is going to stimulate the economic activity. Why? Because we expect basically a negative relationship between the interest rate and the investment level. Okay? So this is going to probably stimulate the economic activity. Whereas basically by increasing the interest rate, we will discourage investment. So this is going to decrease output level. That's what is called basically expansionary monetary policy. The idea is to basically increase the level of economic activity. So why do you really think this? That's to brush up your knowledge about previous chapters. What happened? Why there's a negative relationship between the interest rate and the money demand? Why is that? What is the interpretation of the interest rate?
How much money you have to give back once you borrow money?
So I will write down here, okay, what is the interpretation of the interest rate? What is the interpretation? The basic concept.
If the interest rate is high, you will want to save your money in the bank, and if the interest rate is low, you will get credit and consume it for the economy or investment.
Any proof? Any data?
When the interest rate is high, you don't want to borrow money from the banks because they have to pay them back more money. When the interest rate is low, you will borrow money from the banks. Because
So the interest rate is the opportunity
cost
cost
of borrowing.
of the money. So it means if the interest rate is high, so people basically, or individuals, what happens?
Consume less.
Well, individuals will want to hold less money.
Why?
Because if you hold money, you are losing a higher return. That's what you need to sacrifice.
Can you specify interest rate? In what area? What do you mean by interest rate?
Well, remember, let me write here, interest rate, individuals will want to hold more money. But here we have, remember, we have the nominal and real interest rate. And of course, remember, real interest rate, how do we define the real interest rate? Real interest rate is because, how do we define, what is the link between nominal and real interest rate? I will come back to your question. Well, it's important to basically, here we are talking about nominal interest rate or real interest rate.
Did we have interest rate in the previous semester? We didn't do it.
The nominal interest rate, nominal, is approximately equal to real interest rate plus inflation. So in other words, the real That one is called efficient inflation.
What about the